So you're ready to buy a house, but can you afford it? Can you afford it? Hey guys, I'm Chelsea and welcome back to Chelsea's Change, the financial lifestyle channel where we talk about the trips of life. Trips meaning travel, real estate, investing, personal finances, and strategies to living your life fabulously on a dime. Now we're going to jump right into it. Home buying. I want to tell you guys a story and I want you guys to just envision yourselves in it. Imagine you've decided this is the time, I'm ready, I'm buying this house. And you get on Zillow, you're so excited, you find the perfect house. It has everything that you want. It has the pool, has all the rooms that you want, all the fancy fixings. This is the house. And you call me up because you need a real estate agent and say, Chelsea, I found this house. I found the perfect house for me. Can you help me get it? And I'm like, absolutely, because that's one of the things that I love to do. I love helping people find the homes that they love. But I ask you, do you have a pre-qualification letter? You're like, a pre-qualification letter? What do I need that for? And I'm like, well, let's just talk to the lender. And then you find out that, maybe you shouldn't have been looking at that $2 million house. I want to make sure you guys don't experience that. I've had clients that unfortunately have experienced that, and we had to go back to the drawing board to make sure that they were able to get a home that they love. I'm here, and we're going to talk about the steps that you need to do to make sure that you're buying that perfect house for you. Now let's just get into the steps of the things that you guys need to know to make sure that you can buy that perfect house for you and make sure that you can afford it. Step one is know your budget. I believe in something called the rule of 4. It is taking your net income after tax, dividing it by 4, and the 4 categories are housing, bills, fun, and investing. You don't want to tap into your investing, but if you need to, you can always have less bills and have a little less fun to make sure you have the house that you want. And that will be the amount that you will cap out spending per month with this house. Now, different ways that you can kind of increase or decrease this amount is by saving more, so you have a larger down payment. If you have a larger down payment, that means you have a lower monthly payment. And make sure that it's staying within your budget. Now, example, you make $4,000 a month after tax. Take that $4,000 divided by 4, you have $1,000 to spend on a house on a monthly basis. Okay, step 2, you need to set that budget. So what does that mean? You know that you're looking at houses, and per the little mortgage calculator, it tells you that the houses are going to be $1,300 a month. What do? You say, okay, let me make sure I'm saving this amount or paying down some of your other bills to make sure that you can afford the house comfortably. Now, step 3 will be understanding your credit. Now, credit plays a major part when getting your pre-qualification letter, and we'll get into that in a couple steps. Now, ideally, you need to have at least a 640 to get the best interest rates. Now, 640, you'll qualify for FHA loans. They have some benefits, 3.5% down. It'll get you into a home. Now, conventional loans, typically they're between 3 to 5%. A lot of times I see 5% for the down payment, but you typically need around a 720 or above to qualify for one of those. So if you understand your credit, know your credit, and you're working on that before, you can make sure you're hitting those markers before you even go to the loan lending officer. Now, what is the difference between FHA and conventional? FHA is government funded, and one of the major differences is in the mortgage insurance. It's at 0.85% of the loan amount, much higher than what it would be with the conventional loan. So that's one of the differences, something to keep in mind, not a deal breaker. Now, step 4, understand your debt. Now, if you have credit cards, student loans, other car payments, these are things that are factored into when you are getting your loan amount and getting your pre-approval for the house. And it's considered in something called a debt to income ratio. So it takes how much you make before tax So notice the difference. With the rule of 4 and you're just setting your budget, you're playing with your after-tax money. When they're determining your mortgage payment that you're allowed to make and get qualified for by the bank, it's based off of your pre-tax income, so your gross income. And that's how they determine the debt to income ratio. Typically, around 41% is considered a good debt to income ratio. I've seen some banks go up to around 48, 50%. Who knows right now, but it's happened in the past. The next step would be getting that pre-qualification letter. Link up with your local bank, credit union. If you have a real estate agent, your real estate agent should be able to help you. If you guys still need help, let me know. I know lenders in all 50 states. The next step that I enjoy is you find your real estate agent. Now, while you don't have to have a real estate agent, it is highly recommended because they're able to kind of help go to bat for you. They know things to look for. When I go into houses, I've seen a lot of stuff, so I am able to help guide my clients on some of the things that they should think about and consider when purchasing their home. The next thing would be finding that dream home. So you find the home, you make that offer, and within 30 to 60 days, you guys can close on it. So that's just kind of a quick synopsis about the steps. Now, I'm just going to talk a little bit more about the home buying process and the budgeting process, because one of the things that I want to make sure that I'm doing with this is sharing with you guys not only these check the box steps, but just things to think about. Now, I'm going to jump back to the rule of 4. Why am I saying rule of 4? Why am I recommending that you create a budget on your net income when the bank is looking at your gross income? Now, let's just think back to 2008. A lot of people were qualified, and I know that lending practices since have changed, but off of their gross income, and things happen. Even with the recent pandemic that we had, I know people whose salaries were cut down, and they were now working with less money. The rule of 4 helps you work with the money that you have after taxes. You are thinking about the money that you actually have to spend, knowing that it's going to go up, or hopefully it's going to go up. That's the goal, right? With the gross income, you don't really have as much control of taxes, so we don't know what's going to happen with that. Your net income, you have a little bit more wiggle room, I think. Now, this is not to say that if you find a house, you have $1,000 of housing allowance, and the place is like $1,200. Well, maybe you can take away from the bills amount. There's some things that you can cut back. Or maybe you just pack lunch more. Those are things to consider. But I really, really believe that it's important to have a budget that is based on your net income and not your gross income. Okay, another thing that I really want you guys to think about. I know I mentioned mortgage insurance. That comes into play if you do not put 20% down. Now, like I mentioned with the FHA, it's 0.85% of the loan amount, much higher than it is with the conventional loan. And it really will take a mortgage payment that maybe would be $1,500 to $1,700. Other things that you need to consider and that go into play with determining the mortgage amount are the taxes for the house and insurance, homeowners insurance. Those are things that you also really need to be aware of and know that you have to build into that payment. Now, closing costs. A lot of time people do not think about closing costs. I say when you're purchasing a house, just be ready to spend up to 10% of the home purchase price. And that's with you not putting a lot down. You can get closing assistance, but depending on if it's a buyer's market, seller's market, that may be tough to get. You need to make sure with this you are saving money. It does not mean that it has to go into a bank. We'll have other videos to get into some other creative ways to make sure that you're saving your money properly. But you need to have money that you're able to put down on the house. You also want to make sure you have money for moving costs and furniture. People don't always think about that, but make sure when you're looking to buy this house that you have this beautiful house, but you have some beautiful furniture to put into it as well. Now, we talked about a lot of the expenses when it comes to home buying, but there are some benefits to it as well. One, you're able to write off the interest that's associated with buying your home, your primary home and your secondary home. Now, with this, it's something that you put on your Schedule A. If it's above the standard deduction, along with some of the other things, that is great because you can write it off. You can also write off the real estate taxes associated with it, as well as the mortgage insurance. And if it's the year that you bought the house and there were any points associated, you can write those off as well. Now, I know we didn't talk about points. Points are just a prepayment of interest that allows you to kind of buy that interest rate down. So, points will allow you to take your interest rate from 4% to 3.5%, which actually saves you a ton on money. If you guys want to know more about how interest works, check out my other video that talks about the money basics. It's going to kind of just break down some of the benefits of having a lower interest rate. Okay, other benefits are appreciation. The home gains value over time. I believe there are certain areas that houses are increasing in value 3.5% per year, some a little less, some a little bit more. But that's huge because that means that you have an asset that is gaining value. Now, if you have a home to sell and you've been living in that home 2 of the past 5 years and you're going to sell this home to buy a new one, you get a tax exclusion for any increase on that home. So that means if you sell the house and you have a $250,000 profit as a single person or up to a $500,000 profit as a married person, you get that money tax-free. You don't have to pay taxes on it. So that's one of the other benefits of home ownership. Now, I say all of this stuff. I want to encourage you guys. Buying a home is great. I hope everyone is able to find that home that they love, or at least love right now. Because, your dream home may be your dream home today, and you'll want another dream home tomorrow. That's okay. So join me with the future episodes that we have. Hope you guys found some value out of this, and we'll talk